As part of Fáilte Ireland's business toolkit for community tourism, this calculator has been developed to assist businesses and organisations to implement effective cash flow management structures within their operation. The importance of cash flow management has never been so pronounced. Over the last 18 months, businesses have sought to maintain cash reserves during a sustained period of limited or reduced operational capacity as a result of the COVID-19 pandemic. As we emerge from the pandemic and trading begins to normalise, government supports that were introduced to support affected businesses will begin to diminish. It will be critical that businesses adopt a proactive approach to ensuring that they are well equipped to absorb this reduction in support through increased operational cash flows. The Tourism Toolkit Trading and Cash Flow model is designed to assist in that regard. The calculator is located here on the Fáilte Ireland website, and in this video tutorial I will illustrate how best to populate the model and analyse the outputs. The model consists of three separate tabs: Input Sheet, a Summary Trading and Cash Flow in tabular form, and a Graphical Output Analysis. Once populated, the model will provide the user with monthly trading projections and the resulting impact on your cash balances. In advance of populating the model, you will need the following information. For revenue, you will need projected number of admissions, dining guests, events held, and shop customers as applicable. You will need the average spend for each class of customer. For costs, you'll need the cost of sales percentage, the payroll percentage, and other costs in euro terms associated with each individual source of revenue. For other costs and cash flows, you will need projected overhead costs of your business on a monthly basis, projected government supports on a monthly basis, and other non-trading cash flows on a monthly basis. These will include tax, loan repayments, capital expenditure, etc. For cost allocation, for each cost item, a high-level determination of the fixed and variable element of the cost will be required. In developing your source data projections, you should use prior period trading as a guide or barometer. On the assumption that 2020 and 2021 were heavily impacted by COVID-19 and are not reflective of normalized levels of trading, I would suggest that 2019 may be the most appropriate reference point. Once you have gathered all the relevant information, we can begin to populate the input sheet. All cells highlighted in brown can be populated, while all other cells are locked. The locked cells are formula driven and should not be edited. To build a revenue projection, consider the various revenue streams that your business has. For example, there may be an admission price to your facility, a cafe where you can buy food and beverage, an events centre to host functions, and a gift shop. For each applicable income stream, you should build a monthly projection by estimating the number of guests and the expected spend per guest. Taking admissions as an example, the number of daily admissions each month should be populated here, days open for trading here, and average admissions price here. The product of these three inputs will generate a monthly admissions revenue projection. It is important to consider the impact of seasonality on your projections. For example, you may not be open 7 days a week in the off-season, and daily admissions will likely be highest during the summer months. In addition, consider the impact of concession prices on your average admissions price. The above process should be replicated for all relevant revenue sources. Each revenue source will have an associated direct cost base. There will be payroll costs, purchasing costs, and ancillary costs. To project a cost base, you will need to estimate the level of revenues that will be absorbed through costs. Using food and beverage as an example, for each month you should populate as follows. Cost of sales. Determine what percentage of revenues will be absorbed in buying raw produce or ingredients from suppliers each month, and enter the percentage here. Payroll. Determine what percentage of revenues will be absorbed in paying staff each month and enter that percentage here. Note that payroll percentage in this instance relates to direct staff related to the running of the F&B operation. For example, chefs and waitstaff. Non-departmental payrolls such as general manager and finance staff are included within the overhead costs section. Other. Determine the expected cost per diner of ancillary expenditure such as tableware and menus, etc., and enter the euro value per diner here. The most appropriate method of projecting this cost may be to determine the annual historic cost and divide by the number of diners. Again, the above process should be replicated for all relevant direct costs. All businesses will have a level of overhead cost associated with running the operation. These will range from indirect payroll to electricity and insurance. It is important to factor in all of these costs when preparing your projections. These monthly costs should be populated here. It should be noted that the model includes a wide range of costs, some of which may not be applicable to your business. In this instance, these lines should be left blank. Equally, if you have a cost that is not specifically referenced, this cost can be included within the other line here. For almost all costs, there is usually a fixed element and a variable element. The fixed element remains consistent regardless of the level of revenues you are generating, while the variable element will increase and decrease in line with revenue. Using food and beverage payroll as an example, your fixed costs may be a head chef who is paid an annual salary, while your variable costs may be seasonal staff who are rostered on an hourly basis as required. In order to develop a deeper understanding of your cost base, you should make a high level determination of the composition of each of your costs. The fixed element of your costs should be input here, and the variable element of your costs should be input here. The combined fixed and variable percentages applied should always equal 100%. There are a number of non-trading cash flows that would ordinarily not be included in a profit and loss account, but should be considered for the purposes of developing a full cash flow projection. These include government supports, VAT and corporation tax payments to revenue, and loan repayments. The projected monthly cash impact of each of these should be input here. That completes the input sheet, and we are now in a position to review the outputs. The outputs are provided in tabular form and graphical form on two separate sheets. The tabular output provides a monthly P&L account and cash flow. We will be able to interpret the expected revenue, costs, and profits in a traditional output form. Profits are shown here. A cash flow analysis is performed by taking the opening cash position each month and adjusting for profits and non-trading cash flows. This can be seen here. Finally, a high-level break-even analysis identifies the level of revenues required to cover all of your costs for that period. This is based on the estimated split of variable and fixed costs provided. A general rule of thumb to be applied here is that your break-even threshold is lower when your costs are more variable than fixed. In this regard, it is worth exploring areas where a favorable shift in fixed v variable costs can be affected. This is especially true for businesses that are seasonal in nature. Finally, the model has been built to enable the user to easily project on a fluid basis throughout the year. To this end, you can change the start of the projection period at any time by changing the start month here and the opening cash balance for the start month here. You will see that by changing the month, the information for the months that precede the chosen month becomes nil, and the opening cash position is now at the start of the chosen month. We hope that the model will help you to plan your business's cash flows and trading across the year and ultimately identify periods where there may be constraints on your cash position. The sooner that these potential challenges are identified, the greater confidence you can have in addressing them. The graphical dashboard represents a visual interpretation of the tabular output provided on the previous sheet. Where monthly analysis is provided, the month can be edited here. The following graphs are provided. Revenue mix, illustrating the breakdown of revenues by source for any month. Monthly trading snapshot, illustrating revenues and profits by month. Revenue and profit trends, illustrating the revenues and profits generated each month. This graph should help in understanding the seasonal nature of your business. Break even, highlighting the revenues, break-even revenues, including and excluding non-trading cash flows by month. In instances where the yellow line is below the grey and orange lines, you are essentially not generating sufficient revenues to break even for that month. Monthly cash flow analysis. The columns represent the cash flow generated each month, while the yellow line represents the rolling cash balance at the end of each month. Monthly cash flow snapshot illustrates the cash flow from daily operations versus the cash flow from non-trading cash flows, such as financing costs. The graphs will help in providing a snapshot of performance for the business and can be useful in presenting projections to bodies such as oversight committees or external financing sources. In conclusion, the importance of a cash flow management tool is critical in maintaining control and focus of your overall business objectives. It will provide both clarity and certainty while enabling you to establish operational goals. It will act as a fundamental reference guide to ensure that the goals you set in a holistic business plan are achieving the desired effect of improving the financial performance of your business.